Losses in trading are inevitable. Every trader, no matter how experienced he is, faces losses. But the key difference between successful traders and those who quit is how they manage their losses. In fact, learning to accept and deal with losses can be one of the most empowering skills a trader can develop. So, how do you make peace with losses and use them to your advantage? The answer is mastering the risk-reward ratio. With this approach, you will realize that you don't have to win every trade to be profitable. By the way, if you are looking for high-quality setups and signals, you should definitely check out my Telegram channel. I share real entry points and setups for some of the best projects out there, which can help you grow your deposit step by step. So let's break it down simply. The risk-reward ratio is the comparison between the amount of money you are willing to lose versus the potential gain from a trade. For example, if you are risking $100 on a trade but aiming to take $200, that's 1-to-2 risk-reward ratio. This means you could be wrong more often than you're right and still come out profitable. Imagine placing 10 trades with a risk-reward ratio of 1-to-2. Even if you lose 5 out of those 10 trades, the 5 wins will overweight the losses. If each losing trade costs you $100 but every winning trade earns you $200, the math works in your favor. 5 losing trades minus $500, 5 winning trades plus $1,000, net profit plus $500. The goal is to ensure that your average win is always larger than your average loss. That's the secret to consistent profitability even with a 50% win rate. The next step is knowing how to set your risk per trade. Many traders make the mistake of risking too much on just a single trade, which can quickly wipe out their accounts. A good rule of thumb is to risk only 1-2% of your total account balance on any given trade. This way, even if you hit a losing streak, your account remains intact and you can continue trading. For example, if your trading account has $5,000, risking 2% per trade would mean risking $100 on each trade. This manageable risk allows you to survive bad streaks while positioning yourself for consistent profits over the long period. Now let's talk about a couple of strategies where the risk-reward ratio shines. First, breakout trading. This strategy focuses on catching strong market moves when price breaks through important levels. You will often find setups where the potential profit greatly exceeds the potential loss, making it an excellent fit for a favorable risk-reward ratio. For example, you may risk $100 for potential $300 gain on a solid breakout move. I have explained the breakout strategy in more detail in this video. Make sure to check it out for a full breakdown of how to use it effectively. Zone trading. Another powerful strategy is trading around key buyer and seller zones. When price reaches these zones, it often reacts strongly, offering high reward opportunities with minimal risk. Using the key reward ratio here is crucial because you can enter trades where the profit potential is much higher than the possible loss. If you want this kind of strategy, signals and setups delivered straight to you, don't miss out on my Telegram channel. I share my personal insights, entry points and the best trade setups daily. So you will always have guidance on when and where to enter the market. What to conclude? Remember, trading success isn't about winning every trade. It's about making sure that when you win big, and when you lose small. By mastering the risk-reward ratio, you can turn the odds in your favor. Even with a 50% win rate or less, you can still grow your deposit consistently if you stick to solid risk-reward setups. Trading is all about strategy, discipline and patience. With the right risk-reward ratio and a plan in place, you will be well on your way to achieving your trading goals. Don't focus on avoiding loss, focus on managing them.